What is one aspect of company valuation that actually pisses some buyers off? Stay tuned to find out. I am Nick McLean with 4 Pillars Investors. I'm pretty much the most boring guy in private equity. And while I do have about 20 years of experience in M&A and private equity, you're not going to see me renting Lamborghinis and Ferraris to prove that I'm the latest internet guru. Instead, what we have here is we're going to have some hard-hitting info on what goes into the valuation and also why it's not just the valuation that matters. There are other considerations to take into account. There are whole classes on valuation, and I would love to do a quick hitting 10-minute video and say that that's all you need to know, but the reality is that that's just not the case. And what do those classes fail to cover? Well, one is that valuation is only part of the story. There's an old adage in the industry that essentially says, you name the price, I name the structure. What is meant by that is you could say, I'll pay you $100 million for your business. I'll give you $10 today, and in a million years, I'll give you the rest. There's a lot of play between how you value a company and how you structure a transaction. In addition to talking about that, we'll also talk about everybody's favorite topic, which is taxes. Stay tuned and learn all that you want to know about valuation and probably a little bit more. There are numerous different valuation methodologies, and within these methodologies, there are a lot of different variations and whatnot. I'll talk about 4 depending on how you want to think about the 3rd and the 4th. The first is sum of the assets. Essentially what you're doing is you're looking at the assets of the company, determining what you think a fair market value would be for those assets, adding them up, and that's the company valuation. In our experience, it's been rare whenever we've been able to feel like a sum of the assets valuation is fair for the business. However, there certainly have been circumstances where a company has a high amount of assets and the accompanying cash flow is lower. So it's possible, but it's rare that we will use the sum of assets valuation method when we're looking at companies. The other method is called discounted cash flow. So the idea behind a discounted cash flow is you project future cash flows, you discount those at the appropriate cost of capital, then whatever that discounted end result is, that's the value of the company. Now, there is a lot going on with discounted cash flows, from calculating your weighted after-tax cost of capital, thinking about what your growth rates will be, what your EBITDA margins will be, how much working capital is going to be required. It's very difficult, and it can lead to wide variations depending on what assumptions you make. I will say, though, that while private equity firms in general will forecast cash flows, typically they are forecasting cash flows for a different purpose. What I mean by that is the end result that they're looking for is not a singular value which they plan to offer to purchase the company for. Instead, what they are doing is they're forecasting those cash flows to determine what their expected return would be if the company performs as they expect it to. So for example, they might set up a model so that they are able to determine their MOIC, which stands for multiple on invested capital, or their IRR, which is internal rate of return. The 3rd/4th method would be to use a multiple of EBITDA. Before we start talking about what multiple to use, it might be helpful to understand why, in fact, EBITDA is used. Well, the main point about EBITDA is really to get at a common starting point. What I mean by that is we want to strip out factors such as capital structure. That's why interest is removed. That's why taxes are removed, because they're pass-through tax entities, and there are C Corps which you actually pay federal income taxes. That capital structure, we want to remove that because the buyer might have their own way they want to run the business. Additionally, we want to remove non-cash expenses like depreciation and amortization. Some decry EBITDA as a terrible proxy for cash flow.
Charlie?
Yeah, I think you would understand any presentation using the word EBITDA if every time you saw that word, you just substituted the phrase bullshit earnings.
So while I would agree that EBITDA is a terrible proxy for cash flow, I still think it's a valuable metric to use when starting out the process of determining a value for a business. The other way to determine an EBITDA multiple might be to look at public company comps or public company comparables. Now, that can be helpful. However, we're typically operating in the lower middle market, And our experience has been that the public company comparables, the multiples for those companies are far larger than what we would typically see at the size of companies in which we're interested in.
What you can see here is what's called a football field. It's called a football field because these bars right here can kind of look like a drive on a football field with the yardage markers being right here. We have the 4 different valuation methods we talked about: sum of assets, DCF, precedent transactions, and public company comps. You'll see that only for the latter 2 are low or high multiples used. The values here with some comments. As it relates to the sum of assets, this is the lowest value and rarely used in my experience. For the DCF, mentioned that the models are created, but the goal isn't to arrive at a business value. It's more to arrive at projected returns. For a private equity firm, I would expect if they did a DCF analysis that this DCF would be somewhere in the range of the value for the precedent transactions, but I suppose that's not a requirement. Then we move on to the precedent transactions, relatively big range of 4 to 8x for the multiples. That actually is fairly common just because there's bound to be outliers if the sample size is large or if the sample size is low. Sometimes you have the small sample size and the results not being replicable or appropriate to be used here. However, I think a 4 to 8x range is not inconsistent with what you might see, even though you would like that range to be tighter. Then, as we mentioned, for public company comps, that's the high multiple there is way more than anything you would expect for a transaction in the lower middle market. However, sometimes you do see relatively low multiples whenever there are issues with the public company, or who knows, bound to be a lot of issues why that might be. But again, sometimes you see a very large range for public company comps.
So after seeing that football field, you might be more confused than anything, but what I will tell you is that in the lower middle market, most private equity firms, at least that I have had experience working directly with, are going to almost exclusively look at comparable transactions of comparably sized companies in comparable industries. Look at real estate. Sure, there's the income approach to valuing real estate and a few other methods, but in my experience in talking to both commercial real estate agents as well as residential, so much of it goes back to comps, as they call it, that there's really not as much weight given to other methods. And I would say it's very similar in private equity. Some of those other methods will be used to make sure that those other methods are consistent with what you're seeing here. Now, industry size are perhaps the 2 largest factors when it comes to determining what the multiple might be. However, those should be thought of as starting point. After you have a starting point for what the range of the EBITDA multiple might be, there are several other factors that are going to be used to refine that multiple. Some will have a minor effect, maybe a quarter or a half turn, a reduction or addition, depending on certain factors. Others could have a much larger impact. The first one I'll talk about could have a huge impact, and that is customer concentration. I just can't overstate how critical or how negative it can be for a company. If you have over 50% customer concentration, there is a good chance that you will get half as much as you want for your business, or perhaps more likely, not even be able to sell your business. It's that critical of an issue, particularly for a financial buyer. Now, if you're selling to a strategic, a competitor, a vendor, a customer, then perhaps customer concentration won't be important to them because they are buying your company for other reasons. However, I think that the best method to increase the value of your business and also increase the likelihood that you'll sell it would be to address the customer concentration issue if you have it. And even if you don't, always be mindful of what percentage of revenues each customer in your customer portfolio has. Another factor affecting valuation would be the amount of CapEx the business has. A great example here, it would be asset-heavy trucking. In the trucking industry, you're replacing those trucks every 5 years, and your EBITDA might be $5 million. However, your annual CapEx in order to refurbish those trucks might be $2, $3 or more million. As it relates to valuation, if you're throwing off $5 million of EBITDA, but you're having to spend $2, $3 million or more a year in CapEx, then that is absolutely going to have an impact on valuation. In fact, it might go so far as to cause you not to have a multiple on EBITDA, but perhaps a multiple on EBITDA minus CapEx, or a multiple just on EBIT. Another huge factor is macroeconomic cyclicality. The best example I can think of here would be construction companies. Construction companies make a lot of money. A lot of the folks that own construction companies, they're the ones that have the private jets, the private helicopters, etc. So they make a lot of money. However, there's a lot of ups and downs. There can be banner years for the firms that are followed up by a few years where times are more difficult. As you look at it from a financial buyer, there most certainly will be leverage that is applied to a transaction. And if there's too much potential cyclicality or variability in revenue and earnings, then it will limit the amount of leverage that a financial buyer can put on the target company. If that's the case, then valuation will come down, because many private equity firms are not going to be willing to, double or triple the amount of equity that they can put into a business, especially when it's expected to experience variability, sometimes 20, 30, 50% swings in cash flow. Continuing on the construction example, another factor impacting valuation would be project-based revenues. One of the reasons why construction companies are exposed to cyclicality is because all their revenues are project-based. Each year, you've got to rebuild your book of business. That can have a huge impact on revenue and earnings, and it's going to be taken into account when valuing your business. Another factor to consider is EBITDA margins. Generally speaking, people would like to see at least 15% in terms of EBITDA margins, really probably 20%. If you're getting above 30 to 40%, that's really pretty good, and you're most likely going to get a bump in the valuation for your business. However, what I will say is you get above 50% in EBITDA margins and people start to question it. One aspect of certain private equity firms that I've worked with in the past has really confounded me though. We've looked at these businesses that had, $3-4 million of EBITDA, however, only $8 to $9 million of revenue. Those margins are outstanding. I mean, who wouldn't be excited about a company throwing off that amount of EBITDA and only $8 to $9 million of revenue? However, you talk to the private equity firm and they say, well, companies with only $8 to $9 million of revenue, they just seem too risky for us. We'd really like it to be above $10 million in revenue. And I just always think to myself, okay, so you actually want EBITDA margins to go down so that revenue can be above 10 million. That is just one part of working with various private equity firms that I never quite understood. I love a company that's thrown off $3 million of cash flow on $9 million of EBITDA. It's not making 10 million in revenue. I'm not too concerned about that. Another big factor is perceived growth potential. If you're in an industry or sector that you can demonstrate some evidence that there will be growth, or perhaps it's just company-specific growth, that is absolutely going to impact your valuation. Now, I wouldn't go so far as to say that your multiple will be increased, because the general assumption is that in order to get that value, there needs to be growth potential. However, if you just recently landed a new contract, or if there is something that has happened in the economy or the world that going forward would drastically impact the fortunes of your business, then that could impact your valuation. However, again, I just want to be clear that in any valuation you get for your business, there's an assumption that there is growth potential. And if that growth potential is determined to be too small, then it will actually serve to decrease the multiple somebody that would pay for your business, most likely. Finally, there are industry versus company characteristics or differences that might impact valuation. So for example, there are some industries that primarily serve the automotive industry. So those companies that primarily serve the auto industry are going to get valued lower because the automotive industry is not too attractive in terms of many financial buyers, for better or for worse. Now, if you're a company in that industry, and most of your customers are not in the automotive industry, then that actually might serve to increase the multiple for your business. So whereas some of your competitors might not actually be able to transact and sell their business, you will, albeit not at a improved or higher multiple. The idea here, though, is that if there are aspects of an industry that are negative, If you can demonstrate that your company does not exhibit some of those characteristics or features, then it's going to be definitely viewed as a positive for your business, both in terms of the likelihood of getting a deal closed and also the multiple at which your company will transact. There are three classes of assets that I would consider would get special treatment in a transaction: working capital, real estate, and non-operating assets and or personal assets in the business. Let's start with the most complex. That would be working capital. Now, working capital is a huge issue to discuss, and it is super complex. This is actually the issue that sometimes pisses sellers off because it doesn't seem fair to them on a conceptual level. Now, if you're a very small business that's thrown off cash flow or EBITDA of, let's call it $750,000 or less, then it's more common for working capital to be incremental to purchase price. So for example, your company's throwing off $750,000, it might be a 3x multiple, that would be $2.25 million. Sometimes the purchase price would be increased by the value of inventory and or AR. However, the seller would keep any accounts payable or other current liabilities. However, in the lower middle market, which might be considered EBITDA of as little as maybe 1.5 million, but probably 2 or 3 million and above, any valuation that is relayed to you is going to be inclusive of sufficient working capital to run the business. Now, what is sufficient working capital and why is it included? The concept is that if I'm going to pay $25 million for the business, then I want a company that is sufficient to be able to generate the EBITDA and cash flow that has been occurring in the past. If working capital is stripped out, then I won't be able to achieve that level of cash flow. Instead, your EBITDA margins would be the same, but you would have to invest further capital into working capital. You would have to build up the AR. You would have to purchase inventory. So if it's a $25 million purchase price and working capital is not included, then in practice, you're really effectively paying maybe $28, $30 million for that business. So for that reason, the working capital is included because the buyer is assuming that they can generate the similar levels of cash flow as based off of historical results.
Here is an exhibit that you might see when trying to determine what the working capital peg should be. Here we've used 12 months. I think that's fairly common. Sometimes it's 3, sometimes it's 6. However, the attractiveness of using 12 months is that you would eliminate any seasonality if there is seasonality in the business. I've included the most common current assets and current liabilities, those being inventory, AR, and prepaid expenses. Most common current liabilities as well being AP and accrued expenses. The method would be at the end of month 1 in the analysis period. You would sum up your current assets, get to about 1.6 million there. Sum up your current liabilities, about 674,000. Then you would subtract 674,000 from 1.603 million to end up with net working capital for month 1 being about 929,000. Now, what does month 1 correspond to? That would correspond to 12 months prior to the month in which you have the financials completed. So if you're sitting in June right now, but you only have April financials, then April would be month 12 in this example, and month 1 would be May of the prior year. So we've calculated month 1, similar story for months 2 to 12, and then various different ways you can calculate the average, but the end result is that the average net working capital based off the prior 12 months would be about 926,000. That would be what we call the working capital peg.
Now, this is a little bit off topic here in terms of valuation, but since we're talking about working capital, I thought it might be interesting or helpful to explain what a typical working capital mechanism is as it relates to the purchase agreement. Typically what will happen is you'll go through that process that we described in Excel to determine what the working capital peg would be. Now, let's fast forward to, let's say August 31st is when the deal closes. Now, leading up to August 31st, you'll have an idea for what your actual working capital is, but you won't know until several days after the close. For example, you might get a bill from one of your suppliers on September 3rd that is dated August 31st. That invoice, even though it's received after the close, would still go into the working capital calculation because of the invoice date of 8/31. The point here is that it takes a few days, even a few weeks, to determine what the actual working capital was on the day of close. So for round numbers, let's say that the working capital peg was $1 million. All right. Now, if a few weeks after the close, it is determined and both parties agree that working capital was actually 1.2 million, that's a higher amount of working capital. What happens is the buyers would need to compensate the sellers for that difference of $200,000. Similarly, if working capital were less than the $1 million, then the sellers would need to compensate the buyers for any shortfall. Now, a key point to discuss with your buyer is how will that difference be made up? If there is a difference, is it paid immediately in cash? Is it a note, or is it some other mechanism to repay that? It's not necessarily one size fits all. You know, it might be perhaps the buyer has to pay the seller cash if there's an overage, and if there's an underage, there's some sort of note or vice versa. But again, it's a discussion point, and it's very important to make sure that buyer and seller are on the same page as to how, not only how the true up will be calculated, but how the true amount will be repaid to the party it is owed. The second topic is real estate. Generally speaking, for most financial buyers, real estate will not be very interesting to them. Most financial buyers are more interested in operating assets as opposed to non-operating assets like real estate. So if you're a seller and you are mandating that the real estate be sold with the business, most financial buyers will accommodate that because it's relatively easy to sell the real estate. If the real estate is owned by the business or a related party, then I think it makes the most sense to treat it as a separate entity and have expenses related to the real estate show up on the income statement. So expenses like rent, insurance, and most certainly property taxes. Now, it might be difficult to determine what you think fair market rent is, but the point is that those expenses really need to be on the income statement because that's a truer reflection of how much cash flow the company is actually generating given its level of revenue. As it relates to rent, as it relates to other expenses, my advice would be to go out and get a new appraisal. Figure out or work with a commercial real estate agent to determine what a fair market rent would be. Additionally, what I would encourage you to do is go down the path of evaluating a sale-leaseback transaction. What is a sale-leaseback transaction? Well, essentially, it's where you sell the real estate to a real estate buyer and you lease the property back from that entity or group. You might see sale-leaseback transactions maligned in the media. For example, Red Lobster, the financial troubles they've been having. A lot of that was blamed on private equity. A lot of it was blamed on the sale-leaseback transactions because the rent was too high. What I will tell you is that in underwriting, the sale-leaseback group, whether it's a broker or an actual buyer, will do a lot of diligence to determine what level of rent they think the company can afford. And you will find groups that are more aggressive. You will find groups that are more conservative. At the end of the day, it's really going to depend on you as the seller to determine what you think is the most appropriate level of rent to pay given what cap rate the buyer is willing to pay. We haven't seen too many circumstances where the seller has decided to sell the real estate shortly before selling the business. I'm not saying that that's a bad idea, just offering my experience. And I think a big part of that though is just because, most business owners like real estate. And even if they don't own the real estate for their business, they might own other parcels of real estate. Additionally, I think that sometimes keeping a hold of the real estate is a good play for the seller. You're going to reduce your taxable income for that year. And more importantly, you're going to have a continued reliable source of income from the rental proceeds from that property. So not trying to encourage you to do one thing or the other, but really just trying to paint a full picture as to the strengths and weaknesses of various different methods.
To illustrate how real estate would impact the total transaction value, let's look at this example here. We have EBITDA, which is EBITDA before rent, that's the extra R, of $2.675 million, rent expense of $250,000, and presumably this is not just rent, but it will also be property taxes, insurance, etc., etc. The end result is EBITDA of $2.425 million. We're applying a multiple of 5x. The value of the business is $12.125 million. The appraised value of the real estate is $3.125 million. Total transaction value of $15.25 million. The point here is that this appraised value of the real estate, it might or might not be valid. If you had this appraised a year or two ago, then the property value could have gone up, it could have gone down. If this value seems fair to you, that's great. Maybe you don't want to do any more diligence or homework on that. However, there is the potential to increase your proceeds by taking a more proactive approach. What that proactive approach might be is to think about this as it would relate to what it would look like if you did a sale leaseback transaction. Here we have the same EBITDA of $2.675 million. However, rent is increased to $400,000. That's a increase from $250,000 to $400,000. EBITDA is reduced, multiple is the same. The value of the business is $11.375 million. Cap rate is 7.5%. Therefore, the real estate value, which is $400,000 divided by 7.5% equals $5.333 million. Now, I did take a shortcut there because rent ordinarily would include insurance and other expenses. In this example, it did not for simplicity. But regardless, we have a real estate value of $5.3 million and change. Total transaction now is $16.7 million and change. How does that impact total proceeds? The business proceeds have been reduced by $750,000. The real estate proceeds have been increased by 2.2. The net result being an increase or decrease in total proceeds of about almost 1.5 million. Now, what I would tell you is that you don't actually have to execute this sale leaseback transaction to make this work. You could present to your buyer that based off your research, you think $400,000 rent is appropriate and can be handled by the business, as well as a cap rate of 7.5% would be supported based off of market conditions. Therefore, even though you have an appraisal for $3.125 million, you want $5.3 million and change for the real estate. Sure to be some negotiation, but that might be the way that you start the conversation. This increase in total proceeds would be what you could call real estate arbitrage. Why is this result higher? Well, it really relates to the multiple and the cap rate. If you look at the cap rate, translating that to a multiple, you would take 1 divided by the cap rate. So 1 divided by 7.5%. So what that is, the end result there is that increasing rent will increase proceeds by 13.3 times any increase in rent, whereas increasing rent will decrease proceeds by 5x. So the arbitrage there is 13.33 minus 5. That's why you have the business value going down, but the real estate value going up much more quickly, and therefore increasing your total proceeds.
Whenever you're working with a buyer and they start talking about what assets are going to be included in the purchase, make sure you strip out any personal vehicles, any personal furniture that you're using that you don't want to be included in the sale, those types of things. There's typically going to be very little pushback there, provided that you can show that they are used in a personal nature and are not required by the business. In order to determine the value of your business, you'll need a multiple, as we've discussed before, and you'll also need to know what EBITDA is. Well, how do you calculate EBITDA? Let's just start at the very basics and go from there. There are really 2 methods that you can use to determine EBITDA, and these are really largely based off how your income statement and other financial reports are set up. You can either start with operating income, and add back depreciation and amortization, or you can start at net income, add back other income, deduct other expense, and then add back depreciation and amortization as well.
Now let's see how EBITDA is actually calculated. This is the first method that we will use. Here we have net income. The first step is to add back other income and expense, and here we have it calculated based off of this schedule right here. Interest is not added back because it is already included as an other expense in this area here. Taxes are not included because there are no taxes that were incurred on the income statement. It's a pass-through tax entity for this example. Depreciation and amortization is included. Therefore, the total definitional adjustments are $432,000. 1.993 plus $432,000 equals EBITDA of $2.425 million. Calculation method 2 is we're going to start at net operating income. Net operating income of 2.125. We're going to ignore other income and expenses. The only definitional adjustment, therefore, is depreciation. Therefore, we start with 2.125 million plus 300,000 equals 2.425 million, which is the same result as calculation method 1. This largely depends on how your financials are reported. In this example, they're reported in a manner that doesn't really, either method is equally easy. However, your financials might be different and one method might be easier than the other.
Calculating EBITDA is relatively straightforward because those are what some consider definitional adjustments. Definitional being it's the definition of what EBITDA is, earnings before interest, taxes, depreciation, and amortization. However, when determining the value for a business, there's an important process that is performed to determine what the actual EBITDA figure used should be. And we call that adjusted EBITDA. How you calculate that is you start with your definitional EBITDA and start making add backs. These add backs could be for personal expenses that you run for the business. These add backs could be for family members that are on the payroll that shouldn't be. These could be for one-time events that you can demonstrate are non-recurring in nature and just happen one time. The key part about adjusted EBITDA is that you're trying to determine what level of EBITDA the buyer can expect on a go-forward basis. This is not the time where you add in expected growth or new customers. However, we do want to have a starting point for what we think a fair level of EBITDA would be after taking out the quote-unquote noise. This noise might also be referred to as normalization. Now, this process of normalization, this process of getting to adjusted EBITDA is important for the same reason that folks in public equities require financials to be reported on a GAAP basis. We really want to be able to understand what this business should do in terms of EBITDA on an apples to apples comparison. As a seller, it's very important for you to be able to help the buyer understand what some of these one-off expenses are, what some of these expenses that should be normalized that were too high or too low. Because at the end of the day, the more helpful you can be in this adjustment process, the more likely that your EBITDA is probably going to go up instead of down. And that, of course, leads to increased purchase price for you. Now, how do buyers arrive at adjusted EBITDA? Well, here is part of the diligence process that I don't think anybody likes except for the accounting firm, because that's what they do on a daily basis. And that's what's called a quality of earnings analysis. Any financial buyer is going to require a quality of earnings analysis to be performed by a respected or trusted accounting firm. Now, what will the process look like? Well, the first part of the process is the accounting firm will review the current list of diligence requests and determine what additional items they will need. As long as the list of diligence requests was from your buyer, the accounting firm is going to add a lot more detail. They're probably going to want direct access to your accounting software, which might seem scary to some. However, I would encourage you to do that because it's just going to make your life so much easier. I mean, again, this accounting firm is going to look at your financials, look at your GL on a line-by-line basis. It's going to look at your trial balance on a line-by-line basis. It's just going to be a lot more work on your part and your team's part if they're not provided access to that. Now, I will tell you, this might shock you, but we've actually worked with sellers that run a lot of personal expenses through the business and are uncomfortable sharing their accounting system or their accounting information with a third party because they think that the accounting firm is going to share their information with the IRS or something along those lines. Now, the decision is up to you. However, these accounting firms, they couldn't care less what you do. Their goal is just to strip out anything that is personal and go on with their business. So after that diligence request is provided, the initial diligence call will be set up. That call might be 90 to 2 hours, and you know what? It's not going to be painful, but it's just, again, probably not going to be the most fun. After that call, the accountants will continue to do their work. Typically, the first deliverable that they will provide is what's called the data book. The data book is an Excel file that has probably, depending on the accounting firm, maybe 30 to 40 different tabs. I mean, it's a monster. If the adjusted EBITDA for the last 3 years, as reported by the accounting firm, is in line with what you were expecting or what the buyer was expecting, then game on. You're going to be marching towards close, provided all the other streams of diligence check out. Similarly to the discussions that the buyer or the seller has with their advisors and whatnot would be, considered privileged, not from a legal perspective, but at least considered confidential, and you would not want those conversations to be shared with your buyer. Final part on the topic of Q of E is a sell side Q of E. Now, sometimes the sellers will choose to have a Q of E performed in order to get a feel for what EBITDA might be. Two comments there. The first is that buyers will typically not place a lot of value in the sell side Q of E. That's because oftentimes the adjustments are going to be more favorable to the seller than the buyer, and it's just a different level of objectivity, if you will, whenever the seller is paying to have this analysis performed on its own books as opposed to a buyer having it performed from a more objective standpoint. Additionally, what's also common in a sell side Q of E is that the accounting firm will make pro forma adjustments. So it's what would the company performance be as if X, Y, and Z happened. So for example, if your Q of E date is December 31st, 2023, and in November, you landed a huge new customer account that is expected to ramp to $2 million of revenue per year, that would not be an adjustment to EBITDA. However, it might be a pro forma adjustment to EBITDA so that you can see what the results would have been if that customer had been a customer all year at that $2 million run rate or whatever. A lot of buyers aren't going to place a lot of confidence in those pro forma adjustments depending on the nature of them. And that's just, one reason why a sell side Q of E is not really given a ton of weight by a buyer during this process. Now, what are some typical adjustments? A common area or a common place to start would be owner's comp. Sometimes owners take far less than market wages, sometimes owners take far more. For that reason, that's one of the key places to start. Another area to look at would be rent. As we mentioned, sometimes business owners have the real estate owned by the company and they're not charging themselves for rent expense, facilities expenses that should be factored into what overall cash flow will be. Additionally, there are certain one-time expenses. Maybe it's an insurance settlement, or maybe it's a one-time charge that was incurred because of this or because of that. All those things will be evaluated and determined if they should in fact be an adjustment to EBITDA. As it relates to one-off expenses though, be careful here, because I can see how it might be easy to think that, oh, well, we had this expense this year, but we won't ever have it again. But that's not always the case, and it's not always worthy of being added back. So, for example, you have to rehab a piece of equipment because it stopped working. Now, should that be an adjustment? Well, on the one hand, you haven't really had to rehab that equipment very often. It does feel like a one-off expense. However, a piece of equipment is vital to your operations, or at least you need it to perform certain functions. So on that side of things, it shouldn't be added back. So if in prior years the expense was negligible and this year it was very meaningful, you might just take a 5-year average to determine what the average yearly rehab expense is for that piece of equipment. Similar story for facilities improvements and other types of expenditures that are extending the useful life of your equipment. Now, those one-off expenses are a little bit different than what I would call a normalizing adjustment, though I guess you do normalize some of those one-off expenses, but still there's some nuance. What I think of when I hear the term normalizing adjustment is that there are certain factors within your financial performance that are outliers. So for example, let's say that in the month of December, there was a real bad winter storm somewhere, and for that reason, certain input materials were twice as expensive as they were in previous periods. You could make an argument that there should be a normalizing adjustment to reduce the COGS for that period because of unforeseen circumstances. Now, if this is something that happens every year, then no, you can't make that case. And you can be sure that the accounting firm will ask you if this has ever happened before, when's the last time, how often does it happen, et cetera, et cetera. But if this truly was determined to be a one-time event, then you could make the argument that your COGS for that period should be adjusted, in this case, downward. Another normalizing adjustment might be matching revenues and expenses, especially as it relates to a year-end period. It's very common for business owners to want to push revenue from December to January. Now, why that might make a lot of sense from a tax perspective, it doesn't make the most sense in terms of presenting what your actual EBITDA would be.
Now let's move on to add backs. We have a common add backs added here. Now let me add some commentary. Owner's compensation. Let's say in this example that the owner is taking $300,000 in salary plus $50,000 in benefits. If that's the owner's compensation, is this adjustment appropriate? The end result of this adjustment is saying that owner's compensation of $350,000 is over market, and instead it should be reduced by $150,000, therefore making the owner's overall compensation package equal only $200,000, which would include benefits. Now, is that appropriate? We really need to look at the business. Let's say the benefits in $50,000 are too rich, and really the benefits should only be $25,000. That means, according to this adjustment, that the owner's compensation or his salary would be about $175,000. Is $175,000 really the appropriate salary for the CEO of a business of this size? In this example, it's a $15 million company throwing off EBITDA of $2.425 million. In this day and age, I would say that you would be hard pressed to find a qualified CEO to run this business for only $175,000. As a buyer, I would push back on this. Maybe you don't have to pay that CEO $300,000, maybe only $250,000. But my personal opinion is that a salary of only $175,000 is not appropriate. The other add back, I have rent on here. Sometimes I will see sellers add back rent because they either own the real estate or this or that, or maybe they think that they're paying too much in rent or too little. However, in this example, I left it zero, just because we're assuming that the rent expense recorded right there is fair market value. Really don't have enough information here and in this hypothetical situation to determine if that $250,000 is fair or not. Here we have a roof replacement. Talked about this one a little bit. Here is a good example of where maybe we don't give the full benefit of $300,000. Maybe we only give an add back of $50,000 based off the fact that this type of expense might have to occur more often, or maybe $50,000 is too much. Let's make it $25,000. Equipment rehab really depends on what the equipment is used for. I would definitely push back on this. However, given the nature of rehab, might say that this is required to be done every 5 years. In that case, you could say that the expense or the add back should not be $50,000, but instead it should be $50,000 divided by 5, which equals $10,000. New piece of equipment. Here is a challenging one. What has happened with us in the past is prior to the close, an opportunity presents itself both with a customer and a piece of equipment that it makes sense to purchase that equipment. However, in our view, it's not really fair for the seller to bear all of the expense from that when they're not going to get very much of the benefit. So what we typically have done is we don't give them credit for the add back because that is, there's a multiple that would be applied to that. However, what we would do is we would back out the add back and just increase the purchase price dollar for dollar for how much that new piece of equipment costs. So they are getting benefit of it, just not as an add back to EBITDA. Here's another example, upgraded an old machine. I would say that might be a similar story to a new piece of equipment. Again, in this hypothetical situation, it's hard to determine, but this might be another example where you back out the add back, but give the seller the benefit of that in an upward adjustment to purchase price. Based off of this, we have total add backs let me back out owner's compensation to make that maybe only a $50,000 adjustment. Therefore, we have total add backs of $85,000. EBITDA has gone from $2.425 million to adjusted EBITDA of $2.51 million.
I think that there are ways to create a transaction structure that benefit both parties. And I try not to speak positively about myself. You might notice that I've got a bit of a self-deprecating sense of humor. However, one area in which I do think I am decent, if you will, is coming up with creative transaction structures that really serve to help both parties. I only say that because of the fact that if you see an offer structure that doesn't work for you, I would encourage you to think outside the box, think about why it doesn't work and how you might come up with new or different features of the structure that would in fact work for you. Now, the discussion that follows should help give you some more tools to think about the different levers that you could pull. As it relates to the various components, the first and most important piece of the transaction structure is, as you might have guessed, cash. There are two other types of or categories of consideration that need to be discussed. Those are deferred and contingent. Deferred consideration is consideration that is legally obligated to you. However, it will not be paid to you at the closing. The payment will be, as the name suggests, deferred. Now, why would a buyer want deferred consideration to be a part of the transaction structure? Well, the truth is that a buyer wants the seller to have ongoing, quote unquote, skin in the game. It's really just the idea that after the deal closes, you're not walking away. You guys are partners. If you can't get okay with the idea that you're going to be a partner to some degree with your buyer, then you're probably not ready for a sale transaction just yet. I will say that there's a misconception that buyers include deferred consideration because they don't have the cash. That does happen with individual buyers or very small firms, but in today's day and age, with private equity firms awash in cash, it's more common that private equity buyers walk away from a deal because they are not able to deploy enough capital as opposed to having to deploy too much capital. You might not believe that at first, but it is the truth. I have worked on a lot of deals, and what the feedback has been is that, Nick, love the company, love what you're doing here, love what you want to do here. However, you only need $8 million of capital. We want to write a check that's at least $12 or $15 million. I get it. They have $100, $200, $500 million of capital to deploy. It's hard to deploy that if you're only writing $1, $2, $3 million checks. The point here, though, is that I'll just use the term foolish. If you try to make the argument that the private equity firm doesn't have enough cash, and that's why they are including deferred consideration. Now, as it relates to deferred consideration, what are the primary types? Well, I would say that there are two primary types. One is a seller note. The other is retained or rollover equity. Seller note is essentially you're just lending money to the buyer to help make up part of the transaction purchase price. The features of that seller note, the term would be probably somewhat greater than 5 years, because there will likely be senior debt, and a lot of times the senior lender would not want any additional debt that has a term that is of equal duration to theirs or coterminous with theirs, or a shorter duration. So it would probably need to be a slightly longer duration, maybe just instead of 60 months, it might be 66. Amortization would typically be, the same as the term, or maybe if it's a 5.5-year term, it might be a 10-year amortization. The point here, though, is that it's unlikely to be interest only. You're most likely going to receive principal and interest, though not on a fully amortizing basis. In terms of interest rates, all over the board, I would say that it's probably not going to be much less than prime. However, it's certainly going to be in the single digits, I would say. Perhaps the aspect of a seller note that is the most unsettling, though, is that any seller financing will in fact be subordinate to the senior note on the business. Now, that doesn't mean that you won't be able to attach the business assets as collateral for that note, but again, it is going to be in a junior position to any senior bank financing that is used to finance the transaction. As it relates to rollover equity, the idea here is that you own 100% or whatever that percent might be today. After the transaction, you are going to own maybe 20 to 30 to 40% perhaps of what you formerly owned. Now, if you're selling the assets, if the purchase is structured as an asset sale, there is one mechanism that will be followed. It's a different mechanism if it's a stock purchase. However, again, the idea is that you're going to have continued ownership interest in the business prior to and following the close.
As it relates to rollover equity, the situation is a little bit more complex as it relates to an asset purchase. Here, let's assume that the purchase price is $10 million and rollover equity of $20 million. For simplicity, let's say that $10 million purchase price is going to be paid 100% in equity with no bank debt. What would happen is the buyer would wire funds sufficient to purchase 80% of the company directly to company ABC. After those funds have been transferred, simultaneously with that transfer, company ABC would convey all of the purchase assets to NewCo. After the funds have been transferred and the assets have been conveyed, at that point, the buyer will own 80% of NewCo, and the former owners, as individuals, will own 20% of NewCo. Immediately after the wire, company ABC will have 80% of $10 million, which is $8 million in cash in its bank account. At some point, company ABC would distribute cash to the owners, but that would be independent of the transaction between the buyer, company ABC, and NewCo. Now, question, what happens if there are 3 owners and only one plans to remain? Well, every situation is different, but typically what we have done in that scenario is let the 2 owners exit entirely and have the one owner that plans to remain, that person would sell a much lesser percentage of shares and essentially be the only remaining shareholder after the transaction is closed. For a stock purchase, same situation, purchase price of $10 million, rollover equity 20%, and let's just assume that it's all in equity. The buyer would wire funds not to company ABC, but to the individual owners of that company. After the funds have been transferred, the former majority owners now only own 20% of company ABC, and the buyer owns 80% of ABC. As you can see, much simpler transaction or overall structure when it's a stock purchase as related to an asset purchase.
One final comment as it relates to rollover or retained equity is that if you do have retained equity post-close, then I would encourage you to seek board representation and an approximate ratio to your ongoing ownership interest. So for example, if you own 20% of the business post-close, then I would suggest proposing, the board has 5 people, you get 1 seat on that 5-person board. Most PE buyers that I have familiarity working with would like to see at least 20% in deferred consideration in some form of seller note or rollover equity. However, what I think is the best course of action is for, in your own head, to assume that's actually going to be 30%. Now, it might be better than that. There's potential that it might not be as high. But again, I think just to set expectations, if you have 30% kind of as the mark that you have in your head, that you're not going to be too far off. Now, you have to be very confident in what the business is going to do. You have to be very confident in who your buyer is, but this is just part of the game that you have to play. The third type of consideration that I would consider would be contingent. Now, contingent is definitely deferred almost by definition, but it is not legally obligated at the time of close. What it means is that it is contingent upon certain future events happening, occurring, certain metrics being hit, et cetera, et cetera. Now, typically, what you will see is that the contingent consideration will be called an earnout, and that earnout will be based off of EBITDA. There are a lot of different ways to structure a transaction, and there are a million or 2 million or an infinite, really, ways that you can structure an earnout. So what I will say is that common ways to structure an earnout would be maybe a 1 to 3 year period. So you have to hit a certain level of EBITDA in year 1, and you'll get a certain amount of EBITDA in year 2, you'll get another amount, certain amount of EBITDA in year 3, you'll get another amount. It doesn't always work that way. Sometimes it's 1 year, sometimes it's as long as 5 years, depending on the circumstance. That is how I would think about how the earnout might be structured. Why would this earnout need to be used? Number one reason why we would include an earnout in a offer structure would be because of a difference in opinion between the buyer and the seller as to what the valuation should be. Typically it's whenever the gap is much larger. If it's just a quarter turn or a half turn, typically we can find other ways to compromise. But now, this is not an attempt on the part of the buyers to pay less for your business, because as a buyer, we want to pay the earnout. If the earnout is predicated upon $3 million of EBITDA, then we want to hit $3 million of EBITDA. The final point on earnouts I will make is that even though you might like the idea of having it be revenue-based, that's just not going to work. The difficult part with earnouts is that to some degree, you can game them. For example, on the part of the seller, you could take on a whole bunch of revenue that generates no earnings. And because you took on that low margin work, you qualify for your earnout.
This right here is what's called a sources and uses statement. You see on the left, we have sources of capital, and on the right, we have uses of capital. Sources of capital might be senior debt, seller financing. You add those two to get total debt. And, there might be another type of debt, mezzanine debt, another type of junior debt or subordinated debt. But regardless, you have a section for debt and a section for equity. For the equity section, you would have the new equity coming in from the buyers, as well as any rollover equity. Sum those two sections of total debt and total equity, and you get to your total sources of $21 million. On the sources side, sometimes it's this percentage of sources is included, so you can quickly determine what the ratio or percentage of debt is, what the percentage of equity is. Also include a ratio to EBITDA, so you have a feel for what the level of debt is in terms of EBITDA. So here, for example, we have 2.25 turns of senior debt to EBITDA, which is a relatively conservative capital structure. On the uses side, this is how the $21 million will be used, so to speak. The cash to sellers would be $15.2 million. The deferred consideration is $4.8 million, which is the sum of seller financing and rollover equity, with the total consideration for assets being $20 million, which in this example relates to or corresponds to a 5x multiple, which means that your EBITDA in this hypothetical scenario was about $4 million. Other uses would be fees and expenses, attorneys, quality of earnings, et cetera, and sometimes you will have working capital funded at close. The total of other uses is $1 million. Therefore, you have the proceeds or the uses going to the seller of $20 million, other uses of $1 million, total uses being 21, which exactly equals the total sources as you might expect.
Now, if your business is smaller, let's say 1.25, maybe 1.5 million in EBITDA or less, then the buyer might use an SBA loan to purchase the business. We've done several of those, and it definitely can be a win-win for all parties. There are some unique features associated with SBA loans, though. First, what I will tell you is there is a great variability in terms of the knowledge level of SBA loan officers that you work with. Sometimes you will hear, two banks looking at the exact same deal. One loan officer says the SBA doesn't allow that. The other loan officer says the SBA does allow that. The point here, though, is that if you hear something along the lines of the SBA doesn't allow that, I would encourage you to do some homework. And if you're so inclined to read a very large document, it's all there in the SBA SOP. Another factor to consider is your involvement post-close. One of the core themes or goals in the SBA program is that, and I'm not saying I agree with this, is that the owner or the seller should not benefit from the success of the company post-close. I don't know how that benefits the taxpayer, between me and you, but they think that having the owner only be able to be involved 1 year post-close benefits the taxpayer somehow. Your involvement from a legal standpoint can only be a 1 year consulting agreement, can't be an employee. There have been some changes where you can now have ownership in the company post-close. That is limited to 20% though. If it's 20% or higher, you will also have to personally guarantee the note, which I would expect would be a huge deterrent to owning 20% or more. We just talked about earnouts. Earnouts are not allowed in the SBA structure, again, because that excess or incremental proceeds to the seller post-close. However, you can have what's called a contingent seller note. The idea would be, let's say the purchase price is $5 million. There is a $500,000 contingent seller note. That $5 million will be considered to be the purchase price, and that $5 million is owed to you. However, if certain metrics or criteria are not satisfied post-close, then that loan is forgiven or does not have to be paid back. So it's kind of the reverse of an earnout. It's obligated unless you don't do stuff, whereas an earnout is not obligated unless you do stuff. All other things being equal, on an SBA transaction, real estate actually helps. Banks like hard collateral, they like physical assets, and for that reason, if real estate is included in the transaction, that will definitely be a positive as compared to a lower middle market transaction with a financial buyer such as a private equity firm where the real estate would be neutral at best or perhaps a slight negative just because it's one more component of the transaction that they will have to solve for. We've talked about the various components that might be included in an offer structure. Now let's talk about how those components relate to what we can expect for pre-tax cash proceeds. So the starting point is the purchase price. You will deduct any deferred and or contingent consideration. That's step one, that's the easy part. The next step is to think about a term that is probably used in the LOI and or the purchase agreement, and that term is cash-free, debt-free. What that means is that your pre-tax transaction proceeds will be increased by any cash, and they will be decreased by any debt. So if you have some company trucks that have a loan, then the requirement will be that those loans are either paid off prior to close, and you'll need the payoff letter from the bank to prove that, or as part of the closing process, you will have funds that are actually wired from the buyer to the lender for those trucks or whatever to satisfy the loan. Now, these processes work a little bit differently based off of whether it's an asset purchase or a stock purchase. If it's an asset purchase, it's a little bit easier because you're not going to have to worry about transferring the cash or this or that. If the bank account is considered an asset of the company, then yes, you will have to transfer that. But generally speaking, what happens a lot of times is you maintain that, your operating account, a new one is set up, company sells all the assets into a new company. And for that reason, the prior company maintains its cash balances, it has its debt as well. You can choose to do what you want with those proceeds and you're good to go. The stock transaction is just a little bit different since the money is flowing between the buyer and the seller directly as opposed to the buyer in the company, for those reasons, then there would be separate steps that would be required to effectuate a cash-free, debt-free transaction. Another concept that was most likely introduced in the letter of intent would be escrow. There are at least usually two different reasons why there will be an escrow as required as part of the purchase. First is potential indemnifications for any breaches to reps and warranties. So for example, if you represent XYZ and the company is found to have breached those for whatever reason, then that escrow balance will be used to indemnify the buyer for that breach. The other class is sometimes a portion of escrow is held back for any working capital true-up or issues that might arise as to the overall topic or calculation of working capital. So if there's a shortfall of $100,000, then that $100,000 might be made up by any escrow amount that was held in reserve for that specific reason. Or oftentimes sellers don't like to see that their entire escrow is held up for 15 to 18 months, which is typically the amount of time that would be required to hold that escrow as it relates to any potential indemnifications for reps and warranties. The reason for that is you typically want to get through a full calendar year audit so that the company can understand if there have been any potential breaches. However, what we've done in the past is bifurcate the escrow so that a portion of it is released earlier as it relates to the working capital part. The other piece is held on longer as it relates to indemnifications for reps and warranties. I will say though, unfortunately, the larger piece is for the indemnifications for reps and warranties, so you probably are going to have to hold that back for a longer period of time. However, I will tell you that here is where the buyer is very important in terms of calculating how likely you think it will be to get that. What I mean by that is, in all the transactions that we have ever done, there has never been a circumstance where we have sought to take escrow funds to indemnify us for potential reps and warranties. I mean, typically what we do is there have been examples. I mean, there was an example in the very first deal we did where I could have sought indemnifications based off of representations or warranties that were breached. However, we just had a conversation and said, hey, listen, I don't think this is right. This is not what we agreed to. And we just resolved it with the conversation as opposed to legal means. That's not going to happen with every buyer. So that's why it's important to get to know your buyer and determine whether or not you think that they're more of the type that is going to have a conversation with you, or if they're more the type that is going to go straight to the legal route and try to take every dollar out of that escrow fund that they can. The final bucket would be prorations. If you have experience with real estate transactions, this is a term that you're probably familiar with. Prorations essentially are expenses that the company has incurred that the buyer will benefit from post-close. So for example, if the company prepaid insurance for the entire year, you buy the company as of June 30. If the insurance expense was, $100,000, then the buyer is getting benefit of 50% of that amount post-close. And so there might be a proration for $50,000. In this example, it would be a positive to the seller and a negative to the buyer. Now to everyone's favorite topic, taxes. Not a popular topic for anyone because all taxes do is reduce the cash in our pocket. Another component of this discussion is that the tax situation is far too complex for me to give any advice or recommendations here. Well, I guess I can give you one recommendation, and that is to consult professionals both on a tax side and accounting side, as well as a legal side. Don't listen to me. Don't listen to a business broker. Don't even listen to an investment banker. Tax code changes all the time, not just in the actual code, but in the enforcement of it due to case law. And the only way that you're going to get advice is, again, by talking to professionals that live the tax world day in and day out. You start hearing tax advice from folks, then I would encourage you to seriously question, not necessarily their motives, because I think that their heart is in the right place, but I would encourage you to think about why they feel as though they're educated enough to counsel you on such a complex topic. I'll just leave it at that. As it relates to a transaction, though, there are a few topics and considerations that are at least good to be educated about. First off, the goal is minimize taxable income, thereby maximizing your after-tax proceeds. Perhaps the biggest consideration as it relates to that is whether or not it's going to be an asset purchase or a stock purchase. Asset purchase is typically favored by buyers because there aren't any off-balance sheet liabilities that the buyer would be assuming. However, a stock purchase is typically preferred by the seller because the tax treatment will be, or more of the taxable consequence of that transaction will be taxed at capital gains as opposed to ordinary income. Another goal would be to maximize the amount of taxable income that is taxed at cap gains as opposed to ordinary income. As it relates to an asset purchase, there will be a form that will be required to be submitted by both parties. It's IRS Form 8594. That is essentially the allocation of the purchase price to 7 different classes. The point or the goal here is to be able to allocate higher percentage or as much as possible of the purchase price to lower classes. As you get to, I think it's class 5, maybe 6, it's at that point that your proceeds will start to be taxed as ordinary income as opposed to capital gains, or perhaps not even taxed at all. However, the flip side is that it's not solely up to you as the seller. The buyer has to submit this form as well. And if the buyer's submission does not match the seller's submission, then that's a red flag for the IRS to come in and take a look at things. And I don't think I would encourage that. As it relates to a stock purchase, there are ways that this can be advantageous to both buyer and seller, or at least not disadvantageous to the buyer. One way that this is accomplished is through a Section 338 election. There are various subchapters within the Chapter 338 that relate to different types of entities, whether it's a C Corp or S Corp or partnership or whatever the entity type might be. However, the idea here is that for legal purposes, the transaction is treated as a stock purchase or sale. However, from a tax perspective, it is permitted to be treated as an asset purchase. The seller gets to treat most of the taxable income as capital gains. The buyer will be able to get a step up in basis on the assets that they are acquiring. And again, in certain circumstances, this is the best of both worlds. Now, there's also the potential to use a Section 336E election, which is relevant for certain other types of transactions. Say until I'm blue in the face, you want a tax accountant and you want a tax attorney as part of your overall advisor group. At that point, you say, okay, guys, I'm getting my advisors involved. We're going to analyze this. And, there's a good chance that you'll be able to end up in a place that is mutually agreeable and hopefully minimizes taxes. Well, that wraps it up for this encyclopedia, if you will, on valuation. I obviously haven't hit everything. There are certainly some areas that I missed or chose not to include. However, I hope that after watching this, if you're able to make it through it, you will have a much better understanding of how a company is valued and how that valuation has an impact on what you're actually going to be able to take home after the transaction closes. This video has been set up into chapters so that you can skip around and be able to focus on the area that you want. But again, valuation is a very complex topic. I wish I could have done this video in 5 to 10 minutes, but if you really want to understand this topic, if you really want to be able to position yourself to not only maximize the purchase price of your business, but also to understand how that purchase price is going to translate into how much actual cash you take home, I encourage you to watch this video. I encourage you to bookmark certain sections so that whenever you go through this process, you'll be more educated coming from an objective source that is most likely not involved in your transaction. Now, with all that being said, I know this video isn't perfect, but I guess my question to you is, if you have spent some time watching this video, did you find value in it? And on top of that, what topics did I not address clearly enough, or did I not devote enough airtime to? Please let me know. I would love to help. You can do that in the comments, or I'm certainly open to having that discussion with you one-on-one. There's a link to my calendar in the comments section below. Please reach out. I love talking about this stuff. I love talking about business in general, so would love to hear from you. Thanks for watching.